Good evening, everyone. Thank you for being with us here tonight. We're just going to give it a minute as people are joining the seminar, and we're going to get this kicked off shortly. All right. Good evening, everyone. Thank you so much for taking the time to be with us here this evening. Tonight, we're going to be discussing how to use your retirement accounts to invest in real estate. So we like to start with giving a brief introduction on who we are, Marshall Reddick Real Estate. Well, Marshall Reddick Real Estate started as a real estate brokerage. In any given year, we help about 800 investors purchase, sell, or 1031 exchange investment properties. A good number of those are people using their retirement account funds to invest in real estate. And we're going to have our advisor, Dimitri, on here this evening speaking about exactly how to do that. After this seminar this evening, I'll be following up with everybody who attended to discuss your goals and talk about what it is you're trying to accomplish and how working with both Marshall Reddick Real Estate and Sense Financial, we can help you accomplish those goals. We are also a property manager, currently managing just under 3,000 properties. This is really important because you may find that as you are looking to invest in real estate with your retirement funds, the particular city or state that you live in may not make the most sense. And so by partnering with a company like Marshall Reddick, we are able to help you invest in other markets that may make more sense. And then we can property manage that property for you as well. The majority of our clients have full-time jobs. They are teachers, doctors, firefighters, lawyers, and you name it. But they are not landlords. So by having a professional property manager on your side, you are able to invest in real estate without having to take on another full-time job. We are also a private money lender. And what that means is we help our investors invest in hard money loans. We also help our investors with short-term loans, bridges, IOs, things of this nature. So if you're going through rehab projects, fix and flip projects, things of that nature, we can help you secure the funding necessary in order to get those projects to completion on time. And then we're also an investment fund manager. What that means is we've built a process where our clients can pool their money together, and then that money is invested into mortgages on your behalf. It provides a nice, safe, and relatively work-free return, and it allows you to get into private mortgage investing without necessarily having to be first lien holder position. So it's a one-stop shop for helping our clients invest in real estate over many different facets. And we'll be speaking about all those options when I follow up with you after the seminar. So a little bit about me. My name is Tyler. It's nice to meet everybody. I've been a realtor since 2017. But before that, I went to school for financial information and analysis. My education is rooted in ROI and returns and making safe investments. And so I've got a lot of experience to help you guys accomplish that. Recently finished up the negotiation mastery program at Harvard as well. I've done just over 80 transactions for about 70 million in volume, and I've closed real estate in 13 states. The reason I like to bring this up, I want everyone on the phone to know that you're working with someone experienced and educated. And so when we're having our follow-up calls after the seminar, I want you to feel safe and feel like you're in good hands as we're discussing your investments and what it is you're trying to accomplish. On a personal note, I have over 200 five-star reviews across, various review platforms and was recently featured on the Icons of Real Estate podcast. So this is a footprint of where we have our brick and mortar offices, right? So we have a number in California, a number in Texas. We are in Clarksville and Nashville, Tennessee, as well as Cape Coral, Florida. Each of these markets behaves differently, and thus the investments within those markets behave differently. They return at different speeds and different velocities. Some are going to act in cash flow purposes, while other will be acting in appreciation. And there are some markets that will provide a combination of both. This is important because based on what it is you're trying to accomplish, some markets are going to make more sense than others. And so we wanted to provide a framework for our investors to be able to accomplish what it is they're trying to do. And having footprints in all of these markets makes that possible. And so I wanted to just touch briefly on how we choose where to invest. The point of this seminar this evening is to understand how to use your retirement accounts to invest in real estate. Our hope is you will find a lot of value this evening, and we can pick up the conversation after the seminar and discuss on how to do that. And a big question is that we get from most investors is where to invest. And this is how we determine that, right? So we're looking for markets that have a really strong job market. And going down to the third one here, economic diversity, this is really important. We like to focus on markets that not only have a strong job demand, but have multiple industries within those markets. That way, if a certain industry experiences a downfall, it doesn't cause a mass change in tenant demand and tenant affordability. We're looking for markets that have a high rental demand. The markets that we are in are situated around areas that have a lot of really good long-term renters. We're talking about places with high tech. We're talking about places with a lot of healthcare, places with a lot of military presence, places where we have good, strong tenant base, educated, good income, but it makes more sense for them to rent based on the fact that their jobs, their occupations will move them, every 5 or so years. We're looking at markets that have housing affordability, right? The average home price in the United States right now is about $450,000. And so the markets that we are pinpointing will have market affordability and home prices in that range or lower. We focus on markets with strong education. School districts are a big thing for tenants, especially when we're looking at tenants that we're hoping will stay for more than 1 year. When we invest, we're helping our clients invest in markets where families want to live, and the school districts really do impact that demand. And so we focus on that when we're looking at our markets. And then we're also looking for markets with reliable property management. If we're looking at a market that only has one property manager in town, there is no need for that property manager to make sure that they are doing a good job, that they are working to grow and create a better and better service for their clients. So we like to be places that have a number of good property managers because that just means that that market demands that, and it makes sense for us to property manage there. And so this is what a consultation with me will look like. This is what we're going to be going over when I follow up with you after this seminar, right? And it's a bit of a circle, and it is repeating, right? So we start with your why. We look at goal setting, right? Different investors are going to have different goals that they're focused on obtaining. While some will be focused on cash flow properties, maybe you are nearing retirement and you need to offset W-2 income, right? We're going to be helping you focus on properties and markets where that is applicable and doable. Or maybe you're in the situation where you're focusing on long-term appreciation play. We're going to help you identify markets and properties that will make sense for that. We're then going to evaluate options, right? Every market has different types of properties and different types of investments. Like I had mentioned earlier, they all behave differently and they return differently. So we're going to be looking at your goals and then evaluating options that are going to help you be able to accomplish that. We're then going to look at time frame. Everyone has a different time frame. You may be ready to invest today. You may be planning for retirement years and years down the line. By understanding your time frame, it will help us come up with a plan and a strategy to make your investment goals a reality. We're then going to talk about criteria, right? Single family homes, duplexes, tris, quads, flips, renos, right? Again, they all behave differently and return differently. So we need to understand the criteria when we're evaluating our options. We're then going to identify the markets where this makes sense and these options are possible. And then this is the real key to how this process works, is we're able to introduce you to key players in those markets to help you accomplish those goals. In each of our markets, we have a full Marshall Reddick staff. Our agents are born and raised in those areas, and they specifically focus on helping investors locate good properties for their portfolio. So by having this model, we're able to help identify what's going to work for you and then help you actually acquire those investments so we can help you reach your goals. I look forward to speaking to all of you after this seminar and going through this consultation with you and helping you guys achieve what it is that you're looking to achieve. And with that, I'm going to pass it over to Dimitri at Sense Financial. Dimitri is going to speak this evening on how to use your retirement accounts to invest in real estate. We've been working with Dimitri for a long time. He's helped countless clients of ours use their retirement accounts to purchase real estate. And I'm really excited for the value and the information that he'll be bringing you this evening. So without any further ado, Dimitri, I'm going to go ahead and mute myself, and I'm going to pass the control over to you. Thank you so much for being here this evening and being available to speak with our clients. We really appreciate it.
Tyler, thank you for having me. Can you hear me okay?
Yes, sir, we can.
Okay, great. Well, thank you for inviting me, and it's always a joy to present to your clients. And let me go ahead and jump in. Let's see if I have the control here. Okay, looks like not yet. Just a little bit about myself, as Tyler getting me that control. The name of our company is Sense Financial Services, and been doing this since 2010, and we assisted over 3,000 clients obtain control over about 4,000 accounts that we established. So majority of our clients come as a word of mouth. We don't do marketing or advertising. It's either networking or referrals from our existing clients. Okay, I think I need to share my screen, which I wasn't prepared. So give me just a moment here. Apparently I wasn't able to get the control. So
Hey, Dimitri, I've passed the control over to you. I noticed that when I was going through the slides that the left and right buttons on my keyboard were working better than the mouse. If that's not working, let me know and I will control the slides for you.
Okay, so you're still sharing your screen, right?
Yes, sir.
Because that kind of disappeared for me. I'm not sure why. I do not see the screen. It tells me I need to share my screen. So would you like me to share my screen?
Yes, please. Let's try that.
Okay, so let me give me just a moment here. Slideshow. Okay, so let me just get to the right slide and go ahead and share that. Okay, almost there. Let's see here. Share my screen. Okay, I think I clicked the wrong button here. Share my.
And I just send it over to you to be the presenter, Dimitri. If it's still not working, just let me
Okay,
know. I'll do the slide.
show my screen. Okay, are you able to see my screen?
I think we're still looking at mine, Dimitri.
It says showing screen.
Can you go to the next slide and we'll see if we can see that on our end?
Yeah. So I'm here on the mission statement. Can you see that?
No, it's still showing mine.
Okay. Well, let's see. How can I view that?
There you go, Dimitri. Why don't you just walk through it and I will change your slides for you here.
Okay. So which slide are we on?
We're on the mission statement.
Stop showing screen. Okay, so again, our mission statement is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that all of you work hard for your money, and we just want to come along your side and we want to help you work hard for your money. Let's move to the next slide. This is a IRA makeover, and Jason is one of our clients. This is just an example of what we did for Jason. Jason came to us. He had a couple different retirement accounts. He was losing money, watching his balances go down. So he came over to us. We established a self-directed plan with checkbook control for him. And he was able to acquire a rental property, invest in his brother's manufacturing business, and also purchase a real estate note. So he actually used his 401K to become a bank. And he's immediately start cash flowing about $1,000 a month. And his portfolio now growing because he has assets that are growing in value. Let's go to the next slide. And the next slide is basically a comparison between a conventional and retirement and self-directed retirement account. With a conventional retirement account, you have the options that are limited to the stock market only. With those options, you can only invest in stocks, bonds, and mutual funds. But with the self-directed retirement account, your investment options are virtually limitless. You can invest in residential real estate, commercial real estate, trust deeds, private businesses, and so much more. Let's move on to the next slide, which showing us the options.
Dimitri, sorry, the audience just let me know that they could, in fact, see your screen when you were sharing. So I'm going to pass this back to you. My apology.
Okay, so we're looking at the options. The three options are self-directed IRA, the custodial account, the checkbook IRA, also known as the IRA LLC, or sometimes we use IRA trust, and finally self-directed solo 401K, which is the ultimate retirement plan. So let's look at one of those individually. Self-directed IRA is a tax-deferred trust account that is held with the IRS-approved custodian. It allows you to invest in non-traditional assets because now the custodian no longer places the limitation on the investments, unlike the Main Street custodians such as Fidelity, Vanguard, and so on. They've been around since 1974. The reason they're very little known because your custodian and your financial advisor, your stockbroker, they don't want you to know about this because they want you to invest in conventional investments. That's how they make money. So there is no motivation for them to or to encourage you to know about this. But these types of retirement accounts designed to help people like yourself to put money away for the retirement under Internal Revenue Code Section 408. The benefits of a self-directed IRA is that allows you to invest in non-traditional assets, It gives you the ability to have true diversification. The investment returns are tax deferred or tax free in case of a Roth self-directed IRA. You will pay capital gain taxes on the sale when you sell real estate personally, but when you do it inside of a retirement account, there is no capital gain taxes. You also able to leverage your funds by utilizing a non-recourse financing, which we certainly proudly recommend Marsh Reddick for our clients who are seeking non-recourse financing for their IRAs and 401ks. So let's take a look how it works. Step one is you open a new IRS-approved custodial account. And then step number two, you're going to fund that with the transfer from your existing IRA or direct rollover from a qualified retirement plan. Next, you as the account owner direct the custodian to buy certain assets, and that can be a piece of rental property or again a trust deed. But the disadvantage is that you always have to go through a middleman, the custodian, and every time you do a transaction, there are fees. So for those reasons, people look for the alternative, and checkbook IRA is one of those. But to summarize, the benefits of a self-directed IRA that you have the ability to invest in non-traditional assets, you can achieve true diversification, you can invest, and your returns are tax sheltered from taxes, no capital gains, and leverage with non-recourse financing. Disadvantages of the custodial IRA is that you have to wait for the custodian. So there are delays, you have lack of control because the assets and the funds are under custody of an IRA custodian. You have to deal with the rate tape, you have to provide valuations annually, and pay the fees, all kinds of fees for issuing a check when you buy an investment property or selling, transaction fees and asset-based fees. So the checkbook IRA is a solution for that. It is also known as a IRA LLC or IRA-owned LLC, and that's when special purpose limited liability company is created. It is owned by the IRA and it is controlled by you, so you become the manager of the LLC. It does require IRS compliant setup and operating agreement, but this structure allows you to bypass the custodian when making investments and various transactions, because you no longer do those transactions on the level of the custodian, but you actually do them inside of a special purpose LLC. So how does it work? Likewise, in first example, you open a new account with the IRS approved custodian, then you're going to fund that with the transfer or rollover from existing IRA. Then that's where the difference is. The special purpose LLC or sometimes a special purpose trust is created. This is a single member LLC that is created specifically to be owned by the IRA. You become the manager of that LLC. As a manager, you instruct the custodian to fund the LLC by having the IRA buy 100% units of the LLC. And now you can open a business checking account in the name of the LLC. LLC has its own unique name and its own unique tax ID number. Funds are transferred from the IRA custodial account into the LLC checking account. And from there, now LLC can buy the property. LLC can make the investment. All of the income from those investments going back to the LLC checking account. It's not going to the custodial account. And all of the expenses now can be paid by you, the manager, by simply writing a check or even using a debit card from your LLC checking account. So it's very convenient and gives you the control. The advantages of a checkbook IRA that it allows you to bypass the custodian, meaning it gives you the checkbook control. You have direct access to your funds, so you can do transactions quickly. You no longer rely on the custodian. You have also added protection from litigation. If you buy a rental property, LLC gives you that protection. You have a fixed fees because there is no more transaction fees or asset-based fees. You pay nominal annual fee. And all the assets are held in the name of the LLC, not in the name of the custodian. And then finally, the solo 401k, which is also known as the ultimate retirement plan. It's designed under section 401 subsection K and described as a retirement savings trust. It is designed for self-employed individuals and small business owners without full-time employees. It is not a new type of plan. It's essentially a traditional 401k plan that covers only the owner of the business and possibly the spouse of the business owner. They have been made possible as a result of changes in the tax law called ECTRA, and that took place in 2002. And those changes made many benefits of the solo 401k possible. But it's not for everyone. You have to meet the eligibility criteria, which is 2 points. Number one, you have to have a presence of self-employment activity of any type, shape, or form. And some examples here: you can be a doctor, attorney, property manager, you can do network marketing, some kind of consulting. Maybe you're an independent nurse that don't work for an employer like a hospital, but independent contractor, and so on. So essentially, if you generate income on a Schedule C, you will qualify. But you also have to meet the second criteria, which is absence of full-time employees. And that number is also very important. It has to be under 500 hours a year. So really part-time employees. If you have employees over 500 hours, you may not be eligible for solo 401k. Now, leased employees also not allowed. So if you have a business and you lease employees, essentially they're considered employees. But you can exclude employees that are under 21 years of age and those that work less than 500 hours annually. Let's take a look at the setup. First, you have to have a sponsor of the solo 401k plan, and that sponsor can be an incorporated business, a corporation or LLC, a partnership, or it can be a sole proprietorship. You don't have to be incorporated to set up a solo 401k. One example is being a real estate agent. So if you're a real estate agent, you work with a broker as an independent contractor, and if you're just doing that under your own name and social security number, you're considered sole proprietor, and that's legitimate business type that is eligible for solo 401k. So the sponsor adopts a 401k plan, a plan and trust are created, and now you become the trustee of the solo 401k trust. As a plan trustee, you control it, and that's your role to control and invest plan assets. So all of the assets are held in the name of the 401k trust. So you can buy a piece of investment property, or you can do a loan, all in the name of the 401k trust. You also will open a business checking account at a bank in the name of the 401k trust using a trust tax ID number. And as a trustee of the 401k trust, you become the signor on that bank account, and you're the only one who controls it. All of the income from those investments flowing back into the 401k trust bank account, and all of the expenses are paid from the trust bank account by you. There is no middleman. So again, comparing that with the IRA LLC structure, you don't need a custodian there, and you don't need an LLC. So it's really ultimate retirement plan if you're eligible for it. Now let's take a look at the benefits of the solo 401k. Number one, it has a large contribution limits, over $60,000 per participant, because being a self-employed individual or business owner, you essentially wearing two hats. You own the business and you work in your business. Because of those two components, you can put over $60,000 of your income and shelter that from taxes into your own 401k plan. So again, it's a great tax shelter. Proverbs 21:20 says, "The wise man saves for the future. but the foolish man spends whatever he gets. So if you have been blessed with being a business owner or self-employed and you generate good income, be a wise man. Put some money aside. That's your money for your future you. And you can actually take advantage of your money working for you, because you can invest this money wisely and this money will grow for your future use. Now let's break down and take a look at the details of the contribution limits. As I mentioned, there are two components. First, you can contribute as an employee, elective deferrals. That's up to $22,500 per year. Now, if you're over age 50, you have additional $7,500 in catch-up, making it $30,000 limit. And it can be up to 100% of your self-employed contributions. This component can be, these contributions can be made either pre-tax or after tax in a Roth. You also have the employer profit sharing contributions, and those can be those are always tax deferred because it's a deduction for the business. If you're incorporated business, it's up to 25% of your compensation, which is paid to you as on a W-2 through payroll. And if you're a single member LLC or a sole proprietor, it's 20%. The combined limit of the two is $66,000 for this year. And if you're over 50, that goes up to $73,500. So again, a great tax shelter. I mean, imagine if you're in a business together with your spouse and you're making good income, and you're able to shelter over $120,000, potentially $140,000 of your total income into your own retirement account, you're going to drop your into a lower tax bracket, and you're going to be paying a significantly lower amount. So the tax savings can be $20,000, $30,000, $40,000 potentially if you chose to maximize those contributions. You also can take a participant loan from the solo 401k. The terms of the loan, it's a 5-year. You can make payments monthly or quarterly, and you choose that schedule at the time when you're applying for a loan. The interest rate for that loan is set at prime plus 1%, and you actually paying those interest payments and principal payments back to your own retirement account. So your 401k actually growing by you paying the interest back into it. You can use this loan for any reason, for any purpose. And it enables you to access up to $50,000 or 50% of the balance in your account, whichever is less, for any reason, without any tax consequences or penalties. I will be going over prohibited transactions a little bit later, but there are certain transactions that are not allowed. So by pulling the loan, you can actually potentially execute transaction that might be prohibited if you did that inside of your 401k, but you can take a loan and now it becomes your money. You do whatever you want to do with this. So essentially you're creating your own bank that will never tune you down. And unfortunately, the loan feature or option is not available with an IRA, only with the 401k. You also can take Roth contributions. Roth contributions, basically, there is no restriction on the income, unlike with a Roth IRA. If you're over certain, if your AGI over certain threshold, you're not able to contribute to Roth IRA, but there is no limit on the Roth 401k contributions. And again, it can be up to $30,000, and that includes catch-up. All of the income and gains will be tax-free on the investments that you make with your solo 401k, assuming that you're going to be taking qualified distributions after you reach age 59 and a half and had the account for 5 years. But contributions can actually be accessed at any time. And you can take existing pre-tax money and you can perform a Roth conversion if that's beneficial to you. You want to consult with your CPA, but that's a possibility to do that as well. These plans are very cost effective because there is no custodian, so there is no custodian fees. You eliminate those forever. You eliminate the red tape and delays. As a trustee of your 401k, you're in control, so you can act quickly. They're easy to operate. There is only one requirement as far as the reporting, and that's a short form 5500 EZ. It's only 2 pages, and you use that form to report the asset, total assets in your plan and the contributions you made to the IRS. And there is a threshold requirement of $250,000 of your total plan assets. We actually recommend filing that form regardless of the total plan assets. It's a good practice. The bottom line, it allows you to have true diversification. I think this cartoon makes a perfect illustration. If you have all of your eggs in one basket, and that can be a stock market, your existing IRA or 401k that is invested in mutual funds, that's a stock market. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. I think all of you know that. It makes sense to diversify, to spread your risk over. And the truly self-directed IRA or 401k will enable you to do so. Again, diversification means unlimited investment options. You can do real estate, commercial, residential, you can do precious metals, cryptocurrency, private lending, and so on and so forth. But let's talk about some of the restrictions. And those restrictions are defined under Internal Revenue Code section 4975. It says that you cannot invest your IRA funds in collectibles, life insurance contracts, and in another S corporation. If your business is S corporation, it can establish solo 401k plan, just cannot invest in another S corporation. Also, these rules explain that there are certain disqualified persons who are, your plan is not allowed to engage in any business transaction. And those, essentially, that's yourself and your spouse, your linear descendants and their spouses, and your parents and grandparents, and any entity or business in which one of these individuals holds control and equity or management interests. The exception will be extended family members, siblings, cousin, aunt, and so on. So it's only immediate family members that are not allowed to engage in a transaction with a qualified plan. Let's take a look at some of the examples. Common prohibited transactions are when you engage in a transaction directly or indirectly with a disqualified person, buying a property from a disqualified person. That's not allowed. So people sometimes ask me, if I own a rental property, can I put that in my IRA? Well, that means you're going to have to sell it to your IRA, and that's prohibited. So that's not possible. Also, using IRA as a security for a loan or guaranteeing loan to an IRA is not possible. That's why a loan has to be non-recourse. You cannot lend your IRA money to a disqualified person or selling personal assets to an IRA. That's not possible. Investment in a business in which plan participant or another disqualified person already has 50% or more ownership. So it has to be an arm's length transaction. And also receiving any consideration for your own personal account and the connection with the transaction involving the income or assets of the IRA. So you cannot provide any kind of services and be compensated for that, or even if you're not compensated, providing those kind of services is not allowed. And you're not allowed to commingle funds between an IRA and your personal funds. So everything has to be arm's length, no commingling. You also can buy real estate using your retirement account. The benefit of that is all of the income and gains generated by investments are deferred from taxes. So you pay taxes at a future date. rather than in the year the investment produces income. All the income and gains generated by the Roth IRA actually tax-free. And you have to keep in mind that all the income must go back into the account, and all of the expenses must be paid from the account. So you can't put income from an asset that is owned by your IRA in your personal account, and you cannot pay expenses from a personal account that are related to the investment your IRA or 401k holds. But as I mentioned, you can actually finance the purchase of a property in your IRA or 401k, you just cannot provide a personal guarantee. So that's why a loan must be non-recourse, which means that property is the only security for the loan. There is no recourse against you personally. Typically, those loans require 30 to 50% down. Marsh Reddick offers those kind of loans for IRA and 401k clients. Property must be cash flowing so that it has enough income to pay the mortgage payments, property taxes, and insurance. Lender will also require some reserves, typically 10% of the purchase price. If you do that inside of an IRA, UDFI, which is an acronym for Unrelated Debt Finance Income, will be triggered, and that income is subject to UBIT or Unrelated Business Income Tax. So there's going to be some tax consequences that you want to discuss with your CPA. 401k, by the way, is exempt from that taxation. And here is a link to the list of lenders that offer non-recourse financing. Again, Marsh Reddick is one of those lenders. Now let's take a quick comparison between those three options. So all of them that allow you to invest in non-traditional assets, but you do need a custodian with an IRA and not with the 401k. A custodial IRA does not give you checkbook control, but checkbook IRA, which is another name for IRA LLC, or a solo 401k, both of these give you checkbook control. And the same way, there is no transaction fees for those options. LLC though comes with additional fees. Depending on the state, there might be a fee for the LLC. And for California residents, the workaround is to establish a trust instead of the LLC. So that's a way to avoid the California franchise tax. You can only take a loan from a 401k. Not possible to take a loan from an IRA. Again, UBIT, Unrelated Business Income Tax on leveraged real estate inside of an IRA. 401k is exempt from that taxation. As you can see, the maximum contribution with the 401k is 10 times higher than an IRA, so pretty significant. Also, solo 401k enables you to have a built-in Roth component, which you can make contributions post-tax, or you can do Roth conversion and then grow your account tax-free, essentially for the rest of your life. And solo 401k is not for everyone. You must be self-employed to qualify for that. Well, if you're like these folks riding a roller coaster and you're looking at your retirement account statement and you feel like you're riding a roller coaster, then maybe it's time for change. Look at some alternative investment options, and Marsh Reddick certainly can help you with that. And we can help you provide the vehicle that will enable you to put your retirement accounts in alternative assets like this. I know it's been a lot of information. I had limited time to kind of cram this together, and that's why I would like to offer you a complimentary consultation. Everybody who's on the call, you have unique situations, and we might have some time for questions at the end of today's presentation, but I'm happy to jump on the call with you one-on-one. You can go to this URL, sensefinancial.com. /consultation that will pull my calendar in real time. You can see what's available and you can book that directly on my calendar. This is our office contact information. You can also reach us by phone, or you can write email to us, to our team, and request that consultation or ask any additional questions that you may have. So that concludes my part. I know Tyler has a few more slides to wrap this up. Thank you, and you guys go ahead and type your questions there on the control panel. There is a place to type your questions, and we'll try to get to your questions at the end of the presentation. Tyler, back to you.
Thank you so much, Dimitri. I appreciate you being here this evening for our clients. I just wanted to touch base real quick on a couple things. This is our Marshall Reddick Property Rating ebook. This is a book that we wrote on how to properly class investment properties. When you are searching for investments, like I mentioned before, they behave differently, and often by identifying property class, this is going to help you pinpoint investments that will make sense for you. It's a super easy read and a great place to start. So we want to invite everyone here to check that out. Dimitri, could you go to the next slide for me, please? Cool. And in ending, guys, this is my contact information. Like I had mentioned before, I'm going to reach out to everybody after this seminar, and we'll discuss your goals and what brought you here this evening, and help you come up with a game plan to make those investment dreams a reality. Dimitri, we did get a couple questions. If you have a few moments left, if you could help answer for our clients.
Sure, let's do that.
All right, excellent. So Min asks, if I started as self-employed, set up a solo 401k, then move to a C or S corp, what happens to the old solo 401k account?
Good question, Mina. It's actually it will not be old 401k accounts. This is a typical situation. We have had many clients in this situation who start as a sole proprietors, but then their business grows and they do incorporate or set up LLC. So if you start a solo 401k first as a sole proprietor and then you incorporate, all we have to do, your plan will not be essentially affected. Your investments will not be affected. It doesn't become old 401k. It's the same 401k. We just need to amend that 401k and change the sponsor of the 401k from you being the sole proprietor to now your corporation or LLC being the sponsor of a 401k. So it's a fairly simple change. Our team will take care of that, and none of your investments will be affected. So it's pretty smooth transition, and it's common.
Thank you, Dimitri. Another question that we had from the audience, can I combine my solo 401k with a friend or family member's self-directed retirement account in order to purchase real estate?
That's a great question. And the answer is yes, you can. You can partner up with another retirement plan or individual. You don't want to partner with yourself because you're a disqualified person or again, your immediate family members. But if you have another investor that you want to pull money together in do a deal jointly, that is certainly a possibility, and our clients done that. And yeah, there's no restrictions for that. You can go 50-50, you can go 80-20, 60-40, whatever amount you have contribute to the deal, it certainly can be structured. And that can be done for rental properties. It can be done for even private lending. We've seen clients do that. They fund a deal or fund a loan together using 2 IRAs. That's a possibility as well.
Thank you, Dimitri. And we have one more question. If I have multiple retirement accounts from previous employers, can I combine all of them into a single self-directed account to purchase real estate?
It depends on the type of accounts you have. So if, let's say, if you have a traditional IRA and then you have 401k from the past employer, and then maybe you have a pension, and assuming all of those, the 401k and the pension, if it's a pre-tax, so is your traditional IRA, then yes, you can combine them all in one. But if you have, sometimes people have a 401k and there is a pre-tax money and then there is a Roth money. So if you're not eligible for, well, first let me talk about solo 401k. If you're eligible for solo 401k and you have that 401k with the pre-tax money and after-tax money in Roth, then you can move the whole thing, just those two accounts, the Roth and the pre-tax, into a solo 401k, because solo 401k allows you to have that Roth bucket in it. So you can move the whole thing. But let's say if you have a traditional IRA and you also have a Roth IRA, those are pre-tax and after-tax money, you cannot combine them. So again, if it's the same type and if it's from a 401k to a solo 401k, that can be done. But one exception for a solo 401k, that it will not accept rollovers from a Roth IRA. So if you have a Roth IRA and you have pre-tax money, you cannot move both of them into a solo 401k. Roth IRA can only go into another Roth IRA. So you will need a self-directed Roth IRA for your Roth funds. But otherwise, you should be able to combine.
Excellent. Thank you, Dimitri. That concludes this evening, everyone. Dimitri, thank you so much for being here and providing so much value to our clients. I learn something new every time we do one of these. So I know that there was a lot of good knowledge put out there today for our clients. So we appreciate you. Thank you, everyone, for being here this evening. We know your time is valuable. I look forward to speaking with all of you in the upcoming week. Everyone have a wonderful weekend. And if anyone has any questions whatsoever, please feel free to reach out to me. I'm available to help in any way possible. Thank you, everyone, and have a wonderful night.
Good night.